All right, today we're diving into a really fascinating theory. One that connects global politics, the world's largest oil reserves, and, well, an unexpected ripple effect on Wall Street.
Okay, just picture this for a second. What if, behind the scenes, a massive, quiet agreement was just reached? We're talking about a deal that could completely reshape the global energy map. And, as you'll see, it could have some pretty direct consequences for the financial markets. It's a huge idea, and it all starts with understanding who the key players are.
So you might be asking, how could a deal like this even get off the ground? Well, to get a handle on this theory, we really have to look at what's called the Great Powers Calculus. Basically, who holds all the cards in Venezuela's energy game and why? Coming to some sort of agreement might be the only logical path for everyone involved.
So, first up, let's talk about China. You have to understand, they aren't just another customer here. They are the primary buyer. China snaps up a staggering 65% of all Venezuelan oil. That kind of dominance makes their say in the matter absolutely critical. You see, this whole situation is basically held up by two major players. On one side, you've got China, which has been the economic lifeblood for over 20 years now, and on the other side, you have Russia, acting as the primary supplier of military tech and hardware. They each play very different but equally crucial roles. So here's the bottom line. Given how deeply involved both China and Russia are, the theory goes that no major move by the US regarding Venezuela could ever happen in a vacuum. It would absolutely require some kind of prior understanding with both Moscow and Beijing. It would have to be a negotiated shift. Okay, so let's say a geopolitical deal does happen. The aftershocks would instantly hit the financial world. And this is where our story pivots from geopolitics to finance. It's time to follow the money, all the way from New York to Caracas. And that, of course, leads to the multi-billion-dollar question. If American oil giants decide to go all in to tap into Venezuela's potential, they're going to need a truly staggering amount of capital. So, where in the world would that cash come from? Well, the money trail would probably look a little something like this. First, you'd have the big American energy companies, think Exxon, Chevron, seeing a once-in-a-generation opportunity. But then, they need to pour massive amounts of money into infrastructure. Now, this capital doesn't just appear out of thin air. It has to be reallocated from other places, essentially getting pulled directly out of the financial markets and put into physical energy development. And there's a term for this kind of massive capital shift. It's called a liquidity drain. This sudden move could have very real, very immediate consequences for the whole financial system that depends on that flow of money. So, where are these giant companies going to get all this cash from? Well, the theory suggests it would come from the very programs that are currently propping up their stock prices and rewarding shareholders. We're talking about money that was meant for stock buybacks, for paying out dividends, for buying other financial assets. All the stuff that keeps investors happy. Suddenly, all that cash has a new job. And when you pull that much money out of the system all at once, you get what's called a short-term liquidity crunch. Think of it like this. The pool of cash that greases the gears of Wall Street would suddenly shrink. That creates a major restriction, a traffic jam, for the flow of capital right inside the market itself. Right, but this isn't just some boring financial plumbing issue that only Wall Street insiders care about. The theory argues that a liquidity drain of this size would have a direct impact on the wider market. And that brings us to the final piece of the puzzle, the S&P 500 effect. And this is really the key takeaway. Things like stock buybacks and dividends, they're a huge support system for stock prices. So according to this theory, if you suddenly reduce that support on a massive scale to go fund a giant project somewhere else, you could see a direct, very real hit to the performance of the entire S&P 500. But this whole theory isn't just doom and gloom about the market in the short term. It also points to a pretty significant long-term shift. So for this last part, let's take a look beyond the immediate horizon. If you look past that immediate market turbulence, the long-term results of unlocking the world's largest oil reserves could be absolutely huge. We're talking about a massive energy boom, and that would likely bring incredible economic benefits to energy hubs like Texas and, of course, to Venezuela itself. So that's what we're left with. It's this really fascinating trade-off to think about, right? You have a potential long-term energy boom on one hand versus the risk of some serious short-term market instability on the other. How those two powerful forces end up balancing each other out, well, that could define the next chapter for both the energy sector and global finance.